What is my best mortgage rate? This is the top question asked by borrowers shopping for a second mortgage or home equity loan. However, to understand why you've been quoted a certain rate, you need to understand how a lender comes up with the rate. What are they looking for? And why do rates differ so much from lender to lender? Stick around, and in the next few minutes, you'll learn about the process that will not only make you a smarter shopper, but will also save you a ton of time and money. First of all, why even consider a second mortgage? Well, there are many valid reasons. For example, to consolidate high-interest debt, such as high-interest credit cards that are typically between 19 and 30% interest. Or perhaps due to circumstances beyond your control, you have fallen behind in mortgage payments and need funds to catch up. Whatever the case may be, you may have enough equity in your home to serve this purpose. So the big question is, why not just go to a bank? After all, the rates are lower, and the bank typically holds your first mortgage. However, if you're here, chances are that you've already tried, but were declined. You see, their lending criteria is far more strict. You typically need excellent credit or a FICO score above 680, substantial equity in your property, meaning your house is worth a lot more than what you owe on your mortgage, a low debt service ratio, meaning you're not currently drowning in debt, and finally, a good steady paycheck, meaning if you're self-employed, you may be out of luck. Now, if you meet all these requirements and believe you qualify, then absolutely we can check with the banks first. But ironically, the more you need the money, the less likely you are to get approved by a bank. And even if you could qualify at the bank, you may choose to opt for a private second mortgage instead, especially if you have an urgent need. This is because the banks can take weeks to underwrite your application and get you approved. The average time to get your funds is about 30 to 45 days. A second mortgage, on the other hand, can be closed in as quickly as 24 hours. Now that we know what the bank expects from you to qualify, let's examine what private lenders expect. The first thing to realize is, unlike the banks, there are no standard or hard, fast rules. Documents and other requirements vary widely from lender to lender. This is why you may be quoted a wide range of rates from different mortgage brokers. So, how do lenders determine the second mortgage rate they offer you? The simple answer is, it depends on the risk the lender is willing to take. The number one risk factor that all private lenders consider is your property. They want to know the value of your property and if it's highly marketable. Lenders typically consult electronic real estate databases to answer these questions. How desirable is your home? How quickly have similar houses in a neighborhood sold, and for how much? What is the price trend and economic stability in your area? What is the condition of your home? Does it require major repairs? That being said, it's important to note that lenders tend to have a preference for specific geographic areas. One lender may prefer to lend on rural properties, while another within major urban areas like Toronto, Richmond Hill, or Newmarket. So keep in mind, if you talk to a lender that doesn't prefer your area, you may be quoted a higher rate. From there, generally speaking, private lenders can be classified into two categories. The first, an equity lender, and the second is a lender that performs underwriting. Let's first look at how equity lending works. These lenders look solely at the value of your home, less any mortgages that are on your property. This is what is called home equity. There are no questions about your employment, your income, or even your credit score. Essentially, if you have equity in your home, you can borrow up to 85% of the value of your home as a second mortgage or home equity loan. A lender will generally ask for an appraisal or verify the value of your property with a home inspection. They will also need to verify your current mortgage balances. So you need to have your current mortgage statements ready on hand. If the value of your property is to their liking, then congratulations, you're offered a second mortgage. Note that the less questions asked, the higher the rate will be. It only makes sense as the lender is taking on far more risk by knowing as little as possible about your creditworthiness. That brings us to the second type of lender, the lender who performs underwriting. What does this mean? Well, these lenders take much more into consideration. In addition to examining the value of your property, they ask more questions. They want to make sure that you can make the mortgage payments without any issues. They may ask you to, for example, prove your income by providing bank statements for the last 3 to 6 months, or prove your CRA taxes are up to date by providing your notice of assessment. They may ask you to explain your poor credit or explain the purpose of the loan. And finally, they may ask you to have a solid exit strategy. In other words, how will you repay the loan at the end of the term? These types of lenders may ask any or all of the above questions. The point is, even if your situation is less than ideal, these lenders are far more lenient than the bank. The key takeaway from this is, the more questions asked and proof needed, the lower the risk to the lender and the lower the mortgage rate. This is especially true when compared to the equity lenders. So, what will be your second mortgage rate? Well, this will depend on how many questions you are willing to answer. Fewer questions, higher rate. More questions, lower rate. Examine your own situation and see where you fit. 1. Banks and B lenders. They ask tons of questions, need proof for every response. Excellent credit and lots of equity is required. Rates are between 3 and 9%. 2. Mix and private institutions. They ask fewer questions and may be more forgiving for income and credit requirements. Rates are between 7 and 12%. And 3. Private equity lenders. They may ask some questions about income and credit. Otherwise, the equity in your home is the main qualification factor. Rates are between 8 and 14% or more. So, where do you fit? By now, you should have a better idea of what rate to expect for your specific situation. You should also be able to appreciate that in order to find the most suitable solution, the mortgage broker you choose needs to be very flexible and have access to all types of lenders. And that's where we come in. By being very well connected with unparalleled access to direct funds, we can help you navigate the entire mortgage market. Whatever your situation may be, we're here to help. Visit alternativemortgage.ca to learn more or to book your free discovery call. Thank you for watching. If you found this information helpful, be sure to like and subscribe and drop a comment below. Have a great day, and I'll see you next time.